There is a specific moment during your first big drawdown when the nature of trading completely shifts. Up until then, every drop in your account balance felt temporary. Every minor loss was just a brief setup for the next new high in your equity curve. But then comes the drawdown that doesn't bounce back. The days turn into weeks. The wins get smaller, the losses get stickier, and the equity curve keeps sloping steadily downward. Suddenly, the market stops feeling like a land of opportunity. It starts feeling like an interrogation room. Most trading education prepares you for losing trades. It teaches you about stop losses, risk-reward ratios, and win rates. But almost nobody prepares you for the sustained, grinding weight of your first true drawdown. A single bad trade is a paper cut. A deep drawdown is structural damage. The statistics in this industry are brutal. The vast majority of traders who hit their first major drawdown never make it back to peak equity. Not because their strategy stopped working, but because the drawdown breaks the psychological framework they used to operate. If you want to survive the inevitable downturns that come with this business, you have to understand why so many get trapped in them permanently. Here are 7 reasons why most traders never recover from their first big drawdown. 1. They are blindsided by the asymmetric math of loss. The first trap is purely mathematical, but its impact is entirely psychological. Most beginner traders do not truly internalize the asymmetric math of a drawdown until they are trapped inside one. If you lose 10% of your account, you need an 11.1% gain just to get back to break even. If you lose 20%, you need a 25% gain. If you suffer a 50% drawdown, you don't need a 50% return to get back to where you started. You need a 100% return. When a trader hits a 40% or 50% drawdown for the first time, the sudden realization of this mathematical reality causes instant panic. They realize that operating at their standard, normal pace will take months or even years just to get back to zero. That sudden sense of financial claustrophobia forces them to abandon their normal risk rules, driving them to take massive risks to fix the math quickly. And in doing so, they turn a manageable drawdown into a total account liquidation. 2. The drawdown hits at peak sizing, not peak competence. Drawdowns rarely happen when a trader is feeling cautious. They almost always strike at the absolute peak of a trader's confidence. Here is how the trap sets up. A trader goes on a hot streak. They win 5, 8, 10 trades in a row. Their brain floods with dopamine, and they mistake a favorable market regime for personal genius. Feeling invincible, they double or triple their position size. That is precisely when the market condition shifts. Because their position size is now at its absolute highest, the first 2 losses in the drawdown wipe out the profits of the last 20 wins. The speed of the destruction is disorienting. They aren't just losing money, they are losing money at a rate they haven't psychologically normalized yet. Recovering from a loss when you were trading small is manageable. Recovering from a loss when you were sized to the teeth leaves a psychological scar that makes execution nearly impossible. 3. They shift from execution mode to break-even mode. Before a drawdown, a trader evaluates trades based on quality. Is this setup matching my criteria? Is the risk to reward favorable? Inside a deep drawdown, that objective lens completely disappears. The trader stops trading the market and starts trading their P and L. They enter break-even mode. Every decision is suddenly filtered through a single desperate question. Will this trade get me back to where I used to be? The break-even trap. When getting back to zero becomes your primary goal, you stop taking high probability setups because they don't pay enough and start taking low probability, over leveraged setups because they offer a quick fix. You start cutting winners too early because you are terrified of watching green turn back to red, and you start holding losers too long because closing them officially confirms the new drawdown low. Once your goal shifts from executing a process to reaching an arbitrary dollar amount, you are no longer trading. You are negotiating with a market that doesn't care about your break-even point. 4. They abandon their edge right before the mean reverts. Every legitimate trading edge relies on statistical distribution. That means even a strategy with a 60% win rate will eventually hit a cluster of losses, a period where the market conditions simply do not favor the system. A seasoned trader recognizes a drawdown as the natural, expected cost of doing business. A novice views a drawdown as evidence that their strategy is broken. So, what do most traders do during their first big drawdown? They scrap the strategy. They change their indicators, switch time frames, jump from trend following to mean reversion, or buy a new trading system entirely. The tragedy is that strategies usually hit peak drawdown right before the market regime cycles back in their favor. By jumping ship at the bottom of their performance curve, the trader locks in the full damage of the drawdown and jumps into a brand new strategy with zero confidence, starting the destructive cycle all over again. 5. They fall into the hesitation spiral, selective execution. The psychological damage of a drawdown creates a toxic pattern called selective execution. After taking 3 or 4 painful losses in a row, your brain marks your entry button as a source of threat. The next time a perfectly valid setup appears on your chart, you hesitate, you second guess, you look for reasons not to take it. You watch from the sidelines as that skipped trade moves flawlessly to target without you. Frustrated that you missed the move, you jump into the next setup, one that is messy, late, and off plan just to catch up. That bad trade loses. Now look at what you've done. You skipped the winner out of fear and took the loser out of frustration. When you selectively execute your system, you capture 100% of the losses and only a fraction of the wins. The drawdown stops being a statistical event and becomes a self-fulfilling prophecy created by your own hesitation. 6. They conflate account equity with personal self-worth. For many traders, an equity curve isn't just a representation of capital. It's a real-time scoreboard of their intelligence, discipline, and value as a person. When the equity curve is at all-time highs, they feel invincible. When it plunges into a deep drawdown, it feels like an existential threat. When you attach your self-worth to your account balance, a drawdown feels like public humiliation. To protect their ego from accepting the drawdown as real, traders will do unthinkable things. They will remove stop losses. They will add to losing positions, averaging down into a collapse. They will deposit more money just to cover margin calls on a failing trade. They refuse to take the loss because taking the loss means admitting they were wrong. They would rather risk total catastrophic blowup than face the quiet, uncomfortable truth of a smaller, controlled drawdown. 7. They refuse to accept the boring reality of reconstruction. The final reason traders never recover from their first big drawdown is simple. They refuse to do the slow, unglamorous work required to rebuild. Recovering from a 30% or 40% drawdown safely requires time. It requires dropping your position size down to a fraction of what it was. It requires taking fewer trades, accepting tiny dollar wins, and grinding out small, consistent decisions over weeks or months. Most traders simply don't have the patience for that. They want their money back, and they want it now. The thought of spending 3 months trading small size just to get back to where they were 6 weeks ago feels boring and insulting. So they reject the rebuild process. They keep their sizing high, search for home run trades, and double down on aggression. They try to sprint out of a hole that can only be climbed out of one step at a time, and in their rush, they cave the walls in on themselves. The reality of survival. Every professional trader you admire, without exception, has a major drawdown in their past. The difference between those who survived and those who vanished isn't that the professionals found a way to avoid drawdowns. It's that they learned how to view them correctly. A drawdown is not proof that you are a failure. It is not proof that the market is rigged. It is the mandatory tuition fee required by financial markets to test whether your risk management is real or just a theory you hold when things are going well. The traders who bounce back aren't the ones who aggressively fight the drawdown. They are the ones who respect it. They shrink their size, protect their remaining mental capital, accept the slower timeline, and focus entirely on executing clean decisions until the equity curve turns around. The account isn't ruined when it goes into a drawdown. It's only ruined when you let the drawdown change how you trade. If this video gave you a perspective you needed to hear today, drop a like on your way out and leave a comment with where you're at in your trading journey. Every interaction helps share this message with traders who are fighting through their own drawdown. Respect the process, lower the risk, and earn the recovery one good trade at a time.